You are sitting at your kitchen table on a Sunday morning. Wait, I need to stop myself right there. We have opened too many videos at a kitchen table. Let me place you somewhere different. You are sitting in your car. The engine is off. You are parked in the driveway of a house you sold 3 years ago. You drove past it today for no particular reason. Maybe nostalgia. Maybe curiosity about what the new owners did with the backyard. The neighborhood looks the same. The maple tree you planted is still there. You made $240,000 on that sale. You paid off your line of credit. You took a vacation. You moved on. Your phone buzzes. It is not a text message. It is not a calendar reminder. It is a notification from Canada Post. A registered letter has been processed for delivery to your current address. Registered. Not regular mail. Not a flyer. Registered means someone had to authorize it. Registered means someone needs your signature. Registered means whatever is inside that envelope, the sender needs legal proof that you received it. You look up at the house. The maple tree sways slightly in the wind. Your stomach drops before your brain catches up to why. Welcome back to Canada Property Watch. In our previous investigations, we exposed how the CRA's self-supply rule is being used to detonate HST rebate claims from renovators who believed they had legally qualified for the exemption, and we broke down how the principal residence exemption is being systematically denied to Canadians who failed to report their home sales on Schedule 3. Today, we go deeper. And today, we are talking about something that is shaking thousands of Canadians who thought they had already closed the chapter on a property they sold years ago. We are talking about CRA reopening old home sale files. Not new sales, not 2024 transactions, old ones. 2019, 2020, 2021. Files that sellers believed were dead and buried. Files that the CRA is now pulling back out of the archive and reassessing with a forensic precision that most amateur investors are completely unprepared to face. This is not a rumor. This is not speculation. This is the direct result of a legislative authority that the CRA has always possessed, but is now exercising at a scale and speed that is genuinely shocking even to experienced tax professionals across this country. Let us begin with the foundational question. Can the CRA actually do this? And can a federal tax agency legally reach back in time, pull out a home sale you completed 3 years ago, and tell you that you now owe them money on a transaction you thought was settled? The answer is yes, and the legal architecture that allows them to do it is not new. It has been sitting inside the Income Tax Act for decades. What has changed is the CRA's willingness and technological capacity to use it aggressively. Under the standard rules, the CRA has 3 years from the date of your original notice of assessment to reassess your tax return. This is called the normal reassessment period. Most people know about this window. Most people breathe a sigh of relief when it closes. What most people do not know is that this 3-year window is not a wall. It is a door, and the CRA holds the key. If the CRA determines that you made a misrepresentation on your tax return, the normal reassessment period disappears entirely. There is no statute of limitations. There is no expiry date. The CRA can go back 6 years, 10 years, 20 years. If they believe you were negligent, careless, or deliberately misleading in how you reported a home sale, the clock does not protect you. Nothing protects you except the accuracy and completeness of what you originally filed. And here is where the current wave of reassessments becomes so mathematically brutal. During the period between 2017 and 2022, the Canadian housing market experienced price appreciation that was, by any historical standard, extraordinary. A detached home in the Greater Toronto Area that sold for $600,000 in 2017 might have sold for $1.1 million in 2021. A townhouse in Hamilton that changed hands for $400,000 in 2019 might have closed at $720,000 in 2021. These were not exceptional cases. These were typical. The gains were real, they were enormous, and for a large segment of sellers, they were also incompletely reported. The principal residence exemption is the mechanism that allows Canadians to shelter the capital gain on the sale of their primary home from taxation. It is legitimate. It is powerful. And for the vast majority of Canadians who live in one home, sell it once every several years, and move on with their lives, it functions exactly as intended. But the housing boom created an enormous population of sellers who were not living in their properties in any meaningful sense, who had designated the same property as a principal residence across overlapping tax years, who had failed to report the sale at all because they mistakenly believed that a tax-free gain did not need to be disclosed, or who had stretched the definition of primary residence far beyond what the Income Tax Act actually supports. The CRA knows this. They knew it while it was happening, and the algorithmic infrastructure they have built over the past 4 years is now producing results. Here is what the CRA's cross-referencing system actually looks like in operational terms. The agency receives data from the Canada Mortgage and Housing Corporation on every insured mortgage transaction in the country. They receive property transfer data from provincial land registries. They cross-reference this against hydro and utility consumption records. They look at your declared address on your T1 return versus the address you used on your mortgage application versus the address attached to your vehicle registration versus the address your children were enrolled in school at. They look at rental income declared on Schedule L. They look at the absence of rental income where a property was demonstrably not owner-occupied. They look at renovation permit applications and building department records and compare the dates against the dates you claim the property as your principal residence. This is not a fishing expedition. This is a forensic sweep conducted with machine learning tools against a database of every property transaction in Canada. The output is a prioritized list of files where the statistical probability of misrepresentation exceeds a threshold that the CRA considers sufficient to justify opening a formal review. Your old home sale might be on that list right now, and you would not know it yet because the review begins before any letter is sent. Now let us talk about what happens when your file surfaces from this algorithmic sweep. The first thing you receive is not an audit notice. It is a request for information. A letter arrives asking you to provide documentation supporting your claim of principal residence for the property you sold. They want utility bills, they want lease agreements if applicable, they want evidence of continuous occupation, they want your T1 returns from the years you held the property, or they want bank statements showing the address you used for financial correspondence. This letter reads politely. It uses language like we are conducting a review and we would appreciate your cooperation. Do not be deceived by the tone. This letter is the beginning of a legal process that can end with a reassessment, a penalty, and interest charges that have been compounding since the original transaction date. Let us put real numbers around this so the mathematics of destruction are completely clear. Imagine you sold a property in March 2021. Purchase price in 2018 was $550,000. Sale price was $980,000. Your capital gain was $430,000. You claimed the principal residence exemption and paid zero tax on that gain. You did not report the sale on Schedule 3 because someone told you that if the gain is fully sheltered, you do not need to disclose it. That advice was wrong. The requirement to report the disposition of a principal residence has been mandatory since 2016. Failing to report it, even when the exemption fully applies, is itself a filing error that opens the door to penalties. Now assume the CRA's review determines that you did not actually occupy that property as your primary residence for the full period you claimed. Maybe you were renting it out for 14 months in the middle of the ownership period. Maybe your hydro consumption was inconsistent with a family of 4 living there full-time. Maybe your mortgage was an investor mortgage, not an owner-occupied mortgage, which creates an immediate red flag in the cross-referencing system. The CRA reassesses your return. They deny a portion of the principal residence exemption. Let us say they determine that 2 of the 4 years you owned the property were legitimately your principal residence, and 2 years were not. Under the principal residence formula, you can only exempt the portion of the gain attributable to the years of qualifying use. 2 out of 4 years means 50% of the gain is sheltered. The other 50%, $215,000, is now a taxable capital gain. 50% of a capital gain is included in income, $107,500 added to your income for 2021. At a combined marginal federal and Ontario rate of approximately 53%, your tax owing on that adjustment is approximately $56,000. Then they add the gross negligence penalty. Under subsection 163(2) of the Income Tax Act, if the CRA determines your misrepresentation was the result of gross negligence, the penalty is 50% of the additional tax owing. That is another $28,000. Then they add arrears interest. The prescribed interest rate on unpaid tax has been running between 8 and 10% compounded daily since the original due date of your 2021 return. 3 years of compounding interest on $56,000 of unpaid tax adds another $16,000 to $18,000. You are now looking at a total liability of approximately $100,000 on a transaction you completed 3 years ago and believed was finished. And the registered letter sitting in your mailbox right now is your notice of reassessment. This is not a theoretical scenario. This is the documented outcome in cases that tax litigation professionals across Canada are currently managing in volume. The scale of what is happening right now is not reflected yet in mainstream financial media because these cases move slowly through the system and most affected taxpayers are desperately trying to resolve them quietly without public disclosure. But the numbers are there in the CRA's own annual reports, in the Taxpayer Ombudsman's caseload data, and in the court records of the Tax Court of Canada, where contested reassessments are fought. Now, let us address the most dangerous misconception circulating in real estate investor communities right now. The misconception is this, that if you designate a property as your principal residence on the CRA form, you are protected. That the designation itself is the shield. This is catastrophically wrong. The principal residence designation is a declaration. It is not a magic seal. The CRA is not obligated to accept it at face value. They are entitled to investigate whether the underlying facts support the designation. If your declared principal residence is a property where your water meter shows consumption equivalent to a vacant unit for 18 months, your designation means nothing. If your declared principal residence is 45 minutes away from the school your children attend and the medical clinic your family uses and the grocery store your credit card shows you shopping at 3 times a week, your designation is a piece of paper with your signature on it that the CRA is about to use against you as evidence that you knowingly made a false declaration. The designation does not protect you. The facts protect you. And if the facts do not match the declaration, you are not in a gray area. You are in the territory of misrepresentation. Let us also address the population of sellers who are most acutely at risk right now, because this is not evenly distributed across all Canadians. The algorithmic sweep is producing a specific profile of high probability misrepresentation files. If you sold a property between 2019 and 2022 and any of the following conditions apply, your statistical exposure is meaningfully elevated. You held the property for less than 24 months before selling. Short hold periods are a primary flag because they are inconsistent with the lifestyle patterns of genuine primary residents. Genuine primary residents do not typically buy a home, plan to live in it for 18 months and sell it at the peak of a real estate cycle. Investors do. The CRA system knows this. You had 2 or more properties under your name or your spouse's name during the period of the sale. If you claimed a principal residence exemption on one property while simultaneously owning another, the CRA wants to understand how both properties can simultaneously be your primary residence. They cannot. One of them is not exempt. Your mortgage product was classified as an investment property or rental mortgage at the time of origination. Lenders report this data. The CRA receives it. If you told the bank it was an investment and you told the CRA it was your home, you have created a direct documented contradiction between 2 federally regulated institutions. This is not a gray area. This is a forensic gift to the auditor assigned to your file. You declared rental income on the property in any tax year before the sale. Any reported rental income creates a question about the nature of the property's use, and the proportionate qualification for the principal residence exemption. It does not automatically disqualify you, but it requires detailed documentation of exactly which periods the property was rented, which periods you occupied it, and precisely how the exemption calculation accounts for those periods. If you cannot produce that documentation, the CRA will make their own determination. You did not report the disposition of the property at all on Schedule 3. As stated earlier, this has been mandatory since 2016. Non-disclosure is itself a penalty trigger regardless of whether the underlying gain was fully exempt. The CRA interprets non-disclosure of a real estate disposition as evidence that the taxpayer was concealing a transaction. It escalates the file from a routine review to a formal audit with significantly expanded investigative authority. Now, we need to discuss what your actual options are if a CRA review letter has arrived or you believe one is coming. This is not a moment for denial. It is not a moment to assume the letter is a mistake or to wait and see if it goes away. It absolutely will not go away. The first and most critical action is to retain a tax lawyer, not an accountant, not a bookkeeper, and not the friend who has always done your taxes, a tax lawyer. The distinction matters because communications between you and a tax lawyer are protected by solicitor-client privilege. Communications between you and your accountant are not. Everything you tell your accountant can be compelled by the CRA in the course of a formal audit. Everything you tell your tax lawyer cannot. Before you provide a single document to the CRA in response to a review letter, you need someone in your corner whose advice cannot be weaponized against you. The second action is to gather everything. Every piece of documentation related to the property, the purchase, the occupation, the sale, the financing, the renovation, if applicable, the utility accounts, the insurance policies, everything. Do not organize it yet. Do not decide what is helpful and what is not. That is your lawyer's job. Remember, your job is to ensure that nothing is destroyed, misplaced, or overlooked because the absence of documentation is interpreted by the CRA as evidence of concealment. The third consideration is whether the voluntary disclosures program applies to your situation. If you have not yet received a formal notice of audit or reassessment and you know that your original filing was inaccurate, the Voluntary Disclosures Program allows you to come forward proactively, correct the record, pay the tax owing with interest, and in many cases avoid the gross negligence penalty entirely. The program has strict eligibility conditions and the application must be made before the CRA initiates contact about the specific issue you are disclosing. If the letter has already arrived, this window may be closed, which is why acting before the letter arrives, if you have any reason to believe your original filing was not fully accurate, is the most financially rational decision available to you. The fourth reality is one that no one in the real estate community wants to acknowledge, but that the mathematics of this situation makes unavoidable. If the reassessment stands and the total liability, including tax, penalties, and interest, is a number you cannot pay from liquid assets, the CRA has collection tools that are not available to any private creditor. They can issue a requirement to pay to your employer, directing a portion of your wages directly to the CRA before you ever see them. They can register a lien against your current home. They can freeze your bank accounts. They can offset any future tax refunds, GST credits, or Canada Child Benefit payments against the outstanding balance. They do not need to sue you. They do not need a court order. But the Income Tax Act gives them collection authority that bypasses the normal legal process entirely. This is not hyperbole. This is the statutory reality of what it means to owe money to the CRA. They are not a creditor. They are a government authority with enforcement powers that make every other creditor in your life look patient and gentle by comparison. The Canadian real estate boom created a generation of accidental investors, opportunistic flippers, and optimistic leverage players who made genuine financial gains, but who managed the tax dimension of those gains with a level of care that is now proving to be catastrophically insufficient. The CRA's current reassessment campaign is not punishment for greed. It is the mathematical and legal consequence of a system that was tolerant during the boom and is now, or in a cooler and more scrutinized environment, executing its mandate with the full force of the authority it has always held. The registered letter is real. The reassessment is real. The penalties and interest are real. And the algorithmic infrastructure that identified your file before you knew you were being looked at has been operational for longer than most people realize. The only variable still within your control is how you respond when it arrives. In our next investigation, we are going inside something even more specific and even more immediately dangerous for a population of Canadians who believe they are completely protected. We are going to look at what happens when a married couple jointly owns a property, claims a principal residence exemption, and one spouse had a separate property designated in the same tax year that neither of them disclosed. It is called the spousal attribution trap. It has destroyed financial plans that took decades to build, and the CRA has been quietly identifying these cases in volume for the past 18 months. If you and your spouse have ever owned property separately or jointly at any point in the last 10 years, you need to watch that video before the CRA sends one of you that registered letter. Subscribe to Canada Property Watch. Turn on notifications. This is not content you want to find 2 weeks after it drops.